Hi, Jonathan York, Bay Financial Partners, looking at investment markets. As sort of pretty much expected, the US government has shut down. Now that's all on the back of the failure of Congress to agree a spending bill. And really the sticking point appears to be sort of healthcare subsidies. And it's just going to be interesting to see how that plays out, because potentially with a shutdown, Trump can now sort of close quite a few of the programs that the Democrats sort of want and support. But what it does mean as well is that there's no data coming out in the US, and that's probably working in Trump's favor, because the unemployment data should have been released last Friday, and that was expected to be really pretty weak. They were looking for around sort of 20 to 30,000 jobs to be created. A lot of the big Wall Street investment banks have come out with their own analysis, and sort of the consensus appears to be only around 18,000 jobs created. So if you look at that over the last sort of couple of months as well, that's really a pretty weak labour market in the US. So despite the commentary that's coming out of the White House that the US is the hottest economy, that's really not the case. The data doesn't back that up. And indeed, if it was the hottest economy, you wouldn't need lower rates. And in a strange irony, that could now see the Fed cut interest rates, because obviously, Trump has been pushing for lower rates continuously since he took office. So expected to see a 25 basis point cut from the Fed at its next meeting. But the issue is that inflation is still pretty high. It's running around 2.7 to 2.8, and potentially, it could just nudge above 3% by year end. Now, the Fed's dual mandate is sort of, unemployment and price stability, and so the unemployment is winning out at the moment because that is really pretty weak. But if inflation does touch 3%, it's going to be very hard for the Fed to cut aggressively over the next sort of 6 to 9 months. Because at present, it's looking like there will be 2 further cuts by year end for the Fed, and then potentially a further cut in the first quarter of 2026. But I say that could be hard to sort of implement if you see rising inflation. And what is starting to happening now is, tariffs are starting to impact on prices. Nike, the latest company out there, to sort of see price increases, and that's a direct result of tariffs. Also, the farmers are suffering as well, because certainly just on soybeans, a lack of purchases from China is really impacting the farmers. Now, supposedly Trump is now going to help the farmers with some subsidies coming out of the tariffs that are being collected. But really, that's just taking out of one pot and putting it into another, because the tariffs that's being collected are being paid by either US companies or US consumers, and now you're then giving it out to farmers as subsidies for the lack of purchases on their agricultural products. And all the time as well, sort of Trump is falling in the polls and really struggling to gain any headway. Now, rates just starting to nudge up just a touch out there. 10-year is 413, but a 30-year is 472, and the 2-year holding steady around 360. But what does happen as well is the Supreme Court comes back from this sort of summer recess, and it's going to be very interesting to see the cases that it has to sort of adjudicate on, especially in regard to Trump. You've got the tariffs. Lisa Cook won't be heard until sort of January. Interesting, the World Bank has raised China's growth target for the next year. That's up to 4.8 now. Now oil's come back just a little bit, 62.70 and change. Now in the UK, obviously all eyes on the budget. The current Labour government really got a pretty tricky time ahead over the next sort of 6 to 9 months. You've got a pretty weak economy, really needing further rate cuts out there, but again inflation is just starting to nudge up a little bit. Now in the EU region, CPI currently came out at around sort of 2.2, which is possibly just a little bit above the sort of 2% target range, but still not too much higher that it would prevent the ECB from cutting interest rates. Now the French are really facing another political nightmare out there. The current Prime Minister, I think it lasted all of 2 weeks. He's now resigned. That's the 5th Prime Minister in the last 2 years. Now in Australia, after the RBA left rates unchanged at 3.6, but sort of indicated that potentially there are further rate cuts down the line. Again, the Australian economy is doing okay-ish, but the employment data is starting to get a little bit weaker. So as long as you don't see any surprises on the inflation front, potentially you're looking at a rate cut from the RBA at the next meeting. So if so, that would take the cash rate down to 3.35. Then on current projections, it's sort of forecast to be close to 3% by sort of the end of the first quarter of 2026. Now here in New Zealand, the Reserve Bank finally delivered the 50 basis point cut that's been desperately needed for the economy. So that takes the OCR down to 2.5. Now quite interesting, because certainly at the beginning of the year, the sort of forecast was for the OCR to be around sort of 3.25 by year end. Now obviously the much weaker economy out there has really highlighted the fact that lower rates were needed, and potentially there's still a further 25 basis points in the pipeline at the November meeting. The good thing, it was a consensus cut of 50 basis points, because you remember the last meeting was a 4-2 split for the only seeing the 25 basis point cut. So that's obviously good news for mortgage holders out there, and should see a bit of a boost to the housing market over the sort of summer months. As has been pointed out, compared with a year ago, for about a $500,000 mortgage, you're going to be paying around $400 less per fortnight. So if you look at that, that's a really pretty big boost to the sort of domestic spending ability. So obviously, good news for mortgage holders, but obviously on the flip side, savers are going to struggle as term deposit rates are going to fall. And so historically, that has been good news for New Zealand equities. But obviously it takes a while for this to sort of filter through the economy, and potentially you're not going to see the impact of this sort of rate cut until sort of maybe 5 to 6 months down the road. But the fact it's been implemented out there should be good news, especially as we head into the sort of summer months and obviously the Christmas spending period. So if you are looking for income options, go to the website www.bayfinancialpartners.co.nz for lots of interesting articles. I look forward to speaking to you soon.